We're looking at an analysis report on WULF, ticker WLLF, which argues its recent drop offers a prime entry point for a run-up to $26, all based on a pivot to zero-carbon high-performance computing.
Right, let's get into it. It's a really compelling idea that you're buying a future AI infrastructure play that the market still thinks is just a Bitcoin miner.
But when you're calling for that kind of upside, a 77% gain, the narrative has to be absolutely rock solid.
And that's our first point. While the report correctly identifies WULF's shift from Bitcoin mining to high-performance computing as the critical catalyst, the analysis needs to ground this narrative in concrete, measurable operational progress.
Yeah, right now the zero-carbon AI pivot is treated almost like a magic wand.
Exactly. A secret weapon. It assumes margins will just explode as soon as big tech shows up.
And that's the weakness. There are no metrics in the report to show how real this transformation is, or, how soon it's happening.
Which leaves the entire bull case kind of floating on potential, not on actual demonstrated value. It really weakens the logical path to that $26 target.
You can say it's a future AI infrastructure giant, but the report needs the data to back that claim up.
So the suggestion is to bring in the proof. Introduce specific operational data, maybe current capacity allocations, anything that shows the strategic steps WULF is taking to make this real.
Okay, but how? These big contracts with companies like Microsoft or Amazon, they're usually kept under wraps, right? How can the analysis show progress without proprietary info?
Well, you don't need the signed contract. You need the internal metrics that show the pace of the change.
What does that look like?
For instance, a section comparing WULF's dedicated power capacity, the actual megawatts, that's currently being used for HPC versus what's still mining Bitcoin.
Ah, so you can see the shift happening in real time.
Right. Is it 1 megawatt? Is it 10? That number tells you everything about how fast management is actually moving. It turns a concept into a scorecard.
That's very actionable. And if they really can't share those details?
Then you model it. You could do a sensitivity analysis that shows, look, to get to $26, WULF needs to secure X megawatts of big tech contracts. It frames the risk for the reader.
I like that. It provides a clear milestone. And what about the plug-and-play solution line? It feels a little generic.
It is. This is another spot to add some real specificity. What does plug-and-play actually mean to a hyperscaler?
It's not just about having clean power.
Not at all. It's about why WULF's zero-carbon power is better. Does it meet specific EU or California ESG standards? That's a huge deal for a global tech company trying to hit net zero targets. That's a real competitive edge.
That reframes WULF from just a commodity power supplier into a unique solutions provider. It makes the whole argument much more robust.
Precisely. And once you've established that the pivot is real and measurable, the next question is obvious.
Is the valuation justified?
Exactly. Which brings us to our second critique. The report needs to establish an independent analytical foundation for the valuation targets, rather than just using the average analyst price targets as the main evidence.
Right. This is where the argument feels a bit circular. It basically says the stock is worth $26 because analysts say it's worth $26.
And that's the weakness. It uses the conclusion as the proof. The report tells the reader to look at the math of the consensus, but doesn't show the math. It makes the analysis seem derivative.
So the suggestion isn't to build a massive financial model from scratch?
No, not at all. It's about adding a brief, high-level, independent perspective that validates the bull case. Something that explains the disconnect between the market price and the analyst targets.
So like a quick comparable company analysis? A CCA?
That's a perfect example. Compare WLF's current valuation multiples, say EV to EBITDA, against established pure-play data center companies.
But hold on, wouldn't that be a flawed comparison? WULF is still mostly a Bitcoin miner by revenue.
That's the key point, and the analysis needs to address it directly. The comparison isn't about where WULF is today, it's about showing the destination.
Okay, I see.
It shows the required multiple expansion. If the data centers trade at, say, 18 times EBITDA, and WULF is at 5 times, you've just quantified the re-rating that will happen if the pivot succeeds. It shows why 77% upside is possible.
That connects the valuation directly back to the operational pivot we just talked about. It ties it all together.
Another way is to model it internally. Project what percentage of revenue needs to come from high-margin HPC services to justify that $26 price, completely separate from the price of Bitcoin.
That gives the argument its own legs to stand on, regardless of what Wall Street analysts are saying. It gives the reader a clear internal benchmark to watch for.
And to really build credibility, You have to acknowledge the other side.
The counter-arguments.
Absolutely. Briefly discuss one or two risks. Competition is fierce in this space. Securing those big contracts isn't a given. Acknowledging that shows the analysis is balanced and rigorous, not just wishful thinking.
It anticipates the reader's own objections, which makes the bullish conclusion that much stronger when you get there.
Right, which is a perfect segue to the final point. Integrating the market mechanics into this fundamental story.
You're talking about the high short interest and the technical support level.
Yeah, the analysis brings up the 33% short interest and the support around 1150, but they feel bolted on, like a separate trading idea.
The current placement and framing of the technical data, it needs to be tightly integrated into the fundamental narrative to create a cohesive argument.
The weakness is that separation. It risks confusing the reader. Are they reading a long-term investment case or a short-term trading setup?
I can see that. If the story is a 5-year transformation, why do I care about a short squeeze next month?
Exactly. So the suggestion is to reframe those technicals. They aren't separate ideas. They are the accelerant and the risk floor for the main fundamental opportunity.
Okay, so how do you do that? How do you connect a 33% short interest to the AI pivot?
You frame it as jet fuel. Instead of just mentioning a squeeze, you call it the immediate, violent feedback loop that happens the moment WULF announces a big win, like that first major AI contract.
So the short interest isn't just a trade, it's the measure of how quickly the stock price will snap to that fundamental $26 valuation once the market gets the proof.
Precisely. It turns volatility into a catalyst, and you do the same thing with the support level.
So 1150 isn't just the line on a chart.
No. You reposition it as the technical floor for the narrative itself. You define 1150 as the level that has to hold to confirm the market is starting to believe in the HPC story and not just trading Bitcoin volatility.
So if the price holds that level, it's a sign of conviction in the thesis. If it breaks, it means the market is losing faith in the story, at least for now.
You got it. The technicals become confidence indicators for the fundamental story. And then you bring it all home in the conclusion, stating the 1150 level provides a quantifiable definition of the risk in the report's incredible risk-to-reward ratio.
It brings everything together. The fundamentals, the valuation, and the market mechanics are all telling one single cohesive story.
And that's how you create a truly powerful and persuasive piece of analysis.